Hello, hello. All right, Meta earnings are out, and it's a stock that I hold, so I'm kind of happy here. Meta shares jumped 10% on stronger than expected revenue forecasts as they reported fourth quarter earnings on Wednesday, just a few minutes earlier actually. Shares of the company are up 10% in after hours trading, and they expect first quarter sales to come in the range of 53 to about $56 billion, ahead of analyst estimates that were looking at 51.41, as we're seeing a cool Zuckerberg here. Earnings per share 8.82 versus 8.23, pretty much crashing the estimates here, right? And revenue 59.59 versus 58.59, also a little bit better here. And they said here that they have strong demand that they saw through the end of Q4 and continuing in the start of 2026. Interesting to notice, sales rose 24% year over year. So still growing a ton. That's a ton for a company of Meta's size, really a ton. And the company said its advertising business generated revenue of $58.1 billion. As I've said in the past multiple times, even years ago, this is extremely strong for Facebook, being Meta, being a fantastic platform for advertisers. I've mentioned it so many times. And advertising obviously made about 97% of the company's overall revenue for the quarter. Now, active people came in 3.58 billion, which is always nice to see, actually, having a pretty huge, actually, a humongous here base of users. Now, capital expenditures related to artificial intelligence are obviously going to be extreme here. All these big companies, actually Amazon, it's actually Amazon, Google, Meta, and Microsoft that are trying to sort of like pose some threats to Nvidia and compete in the space of even semiconductors, actually. And they have expectations that were at about 110, and they are still spending significantly more than even that, which is frankly insane. It's also nearly double how much Meta spent on capex in 2025, right? So seriously spending a ton of money here in UI, understandably so. As I mentioned in the past, also I do believe that this is going to be the thing of the future. Actually, makes a ton of sense to be spending, because the things I've seen out of AI, myself actually making the application that I'm presenting data with, it's actually insane, and I think it's gonna be growing tremendously. Now, Meta laid off more than 1,000 Reality Labs employees in the VR stuff just a month ago. This, suppose, is like metaverse people. So metaverse nobody really liked. It was like money down the drain. But frankly, for investors, again, as I've said in the past, that is not what matters. What matters is how much the company is growing through the years, and this is why I made a ton of money actually here with Meta when I bought it. I think it was about 140 or so, and I still have quite a lot. I've sold some, but I still have a lot. And right now, I believe After Hours is going to be at about 710 soon, or something of that sort. So yeah, growing nicely. But P ratio sitting at 28. This is gonna be a little bit higher now with the price getting at about 710 or so. And outstanding shares going down because the company obviously was purchasing through the years where it was actually down in its stock price, like the last 3 years or so. Look at this trajectory. Happy to see as as a shareholder. And revenue, net income, total equity, free cash flow, all of these are going up and will continue going up with the new report, which the tool will have obviously the moment it's actually out from the SEC, once it's submitted. And gross profit margins and net income margins, operating margins, all of these increase. And return on assets here and equity and all of these returns. Actually, the tool explains exactly what they are and how we have thresholds that we are checking. But a company like Meta is basically destroying all these thresholds, as you see, with a good being at 5%, they're doing 20. So yeah, it's a fantastic company. No debt, obviously, practically, virtually no debt here. Not that they would need to get. Companies of this caliber mostly get debt just to get advantage of the interest. It's because it's basically like free money when the rates are down. They don't really have troubles with that. It's frankly, that's the main reason for that. And if we take a little bit of a look at the deep dive, the AI deep dive of the past, you'll see what was happening in the previous quarter, where it was obviously marked very, very high at 71 total, with just some regulatory stuff here being an issue. But these are usually more often than not, they are just noise, and for Meta for sure. And yeah, it's mostly about scaling with AI, the bet that they have, some taxi stuff. Nothing really too troublesome for Meta, making tons of money. But they are spending, obviously, understandably, which is what they want to do. And again, spending on AI makes a ton of sense. And apps make a fortune. The metaverse and salaries are eating it up. Understandably so, the metaverse massive fail. But again, as I mentioned earlier, not a huge deal. They will obviously decommission it slowly and we'll forget about it because, yeah, this was actually doomed from the very beginning. They had no chance. Now, I did create some new things around the stock alerts, which are going to be published in the tool very shortly, probably in the next day or two, with charts. Still working on this a little bit, but they can tell you very nice things about the company. And you'll see here how their margin trends, their capital efficiency increases through the years. Incremental margins are doing better. I don't want to go through all the details now because the video is going to be huge, but we can potentially make a video in the future and explain all these in more detail, or you can take a look at stockaiinsights.com. There's a free account. You can actually take a look at what the tool provides, which is a ton of things. But the thing that I will do, because it gives us a nice idea of what the company is doing, is the DCF model. I want to see what's going on, even though the company has high capital intensity, understandably, meaning that they spend a ton of money in capital expenditures. That's part of the revenue and part of their operating cash flow. About 20% of revenue or 40% of operating cash flow goes into capital expenditures, which is nice to see, in my opinion. But this will obviously skew the cash flows downwards. It's something that you would expect and you have to take into account. So you will see a lower value because of this. But still, it's taking into account the fact that they spend so much in capital expenditures. This is actually very legit here. So because you have to consider that a ton of money actually goes out for capital expenditures, bringing down the cash flows that get to shareholders pretty much for the sake of investments in the future, like the AI. So having this kind of price here while they spend so much money in capital expenditures is kind of wild. I would say that seeing this even now, the company wouldn't be insane to buy. Absolutely not. Now it's gonna be up 10%, so it's gonna be a little bit more expensive. It looks like, but yeah, they are doing really, really well, really, really well. Do tell me what you think about Meta, guys. Whether you are buying or whether you bought when we were suggesting in the channel wildly in the past, and you made good money, hopefully. Or what other companies potentially you would be buying, or also if you want me to take a look at some specific ones, write a comment below. And please leave a like, that helps a ton. And I'll see you in the next one. Bye bye. Actually, there's going to be a video right after this for Microsoft, which is reporting as well, and also Tesla, I believe, in the next few hours. So I'm gonna be making videos for both. Thanks for watching. Bye.